Good evening, everyone. Time for this week's silver update. Well, we have breaking news here. The S&P has downgraded the credit rating in the United States from AAA to AA+. It's going to be a very interesting week next week. It's interesting that the S&P waited until 9 p.m. on Friday night to do this downgrade while the markets weren't trading. So, are we going to have a Black Monday? We don't know. It's going to be very interesting to see. I've got a number of topics I want to cover. I wanted to continue with some of the ideas that were in my last video about the deflation scare that we're going through. The first thing I wanted to bring up is the chart of the federal funds rate, and I'm going to tie that in with a couple of things I'm going to talk about, but I just wanted you to look at this chart to give you an idea. This is a chart of the federal funds target rate. Now, the Fed funds rate, like the discount rate, it's a rate that has to do with how the banks borrow from the Fed and all this complex stuff. Really not important. If you look at the chart, the table of these rates, it gives you a better idea. It's right there on the chart. You can see basically at 2009 it tanked to the zero line and stayed flat ever since. But if you get down here to the table, you can see starting in 2008, you go to the beginning of the year in 2008, we had 4.25%, dropped to 3, dropped to 2.25%, dropped to 2 in May, and in June 2, 2, 2, 2, 2. Then we get the real financial crisis in the fall. We go down to 1, and then 1 in December, and then starting in January of 2009, the federal funds rate is 0.25%. This rate has held for 1, 2, nearly 3 years running. So the first thing I want to propose is that that's not a market. The markets are dead. There is no market. You don't live in a country anymore that has free markets. There are no free markets for interest rates in this country. This is a dead market. So that's very important, because I'm going to show you later how, although silver is not a dead market, it's becoming very close to a dead market in the sense that it's a fake market. So let's jump real quick to this Fed funds rate chart all the way out, just so you can get a historical perspective. The time frame we just looked at was 2009 to the present, this dead period here. You can see that we have some other corresponding periods. This period after the 2000 recession and the dot-com crash, when the Fed lowered rates and held them low for a record amount of time for that time, but finally they recovered with the housing boom, and we got a rise of almost to 6% in the Fed funds rate after this. If you remember back in the Clinton era, the beginning of his presidency, they were lowering. They got down to 3, held it at 3 until the economy recovered, and then they ratcheted it up to 6. So you can see we're stair-stepping down to death, basically, because that's zero. You can't go lower than that. Well, you can, and Japan actually did, where you pay people to borrow money. But effectively, this is as low as you can go unless you're dropping money out of helicopters. So, for all intents and purposes, the interest rate market in the United States is dead. Now, we want to compare that to this headline, and you can see that it makes no sense. How can the first downgrade in history of U.S. sovereign debt correspond with zero interest rates? The only way that a downgrade of sovereign debt can correspond with zero interest rates is if there's no free market whatsoever. There isn't a market at all. It's completely rigged. And this is what Bixware has been saying for some time, that you're not looking at real markets. You're looking at government-controlled, computer-controlled markets. Now, I wanted to take a look at silver in regards to that. The first chart I want to pull up is, this is a silver Dow cross, and we're on the 5-minute chart. Now, if you remember, the sell-off in the Dow, we have to pull out a little bit to see that. So we'll pull out to the 10 minutes. Actually, maybe the 30-minute will give us a better view. But if you remember, the sell-off in the Dow started somewhere back. They were around 12,800 on the Dow at about the 21st of July. We started a slow decline, and silver was still climbing, and then it turned down and started to fall down with the Dow. And then as the Dow continued down with the budget debate, gold exploded higher on the projections of what that would portend, and silver came along for the ride. And silver was rising and the Dow was falling until we got to this point right here. Now, this is where we're going to come closer in to take a look at it. Let's go back to the 5-minute. And you can see that this big collapse from about Dow 11,900 to, this is our 500-point down day. You can see that we had a period of time from about the open at 9:30 to around 11 o'clock. So an hour and a half where the Dow was in dramatic free fall and silver was trading the same as gold, just kind of rallying and staying in the same place, but not really moving too much, until we reached this point right here, right before 12 noon, when we see a trade of 25,000 contracts in silver, which is right there. And then we had a continuous pummeling of the silver price with 10,000, then 12,000, then 15,000, then 10,000, then 10,000, then 15, a bunch of 5s, another 10, another 15. So just a enormous amount of volume coming in. If we would have been a normal day, it would have been just, this would have continued and then petered off. None of this would have been in there. So you can see that a tremendous amount of selling volume came into the silver market. Now, the mainstream economists will tell you the accepted explanation for this is that at some point, either A, a bunch of people needed to raise cash because their other positions in the stocks were getting decimated, so they had to sell their silver positions to raise that cash. I'm going to prove that's false. And then the other position is that the projections for economic growth drastically fell off with the stock market sell-off, and therefore that became very bearish for silver in the sense that it's an industrial commodity, and for that reason it sold off violently. And I'm going to prove that's false. So let's jump over and take a look at the open interest. Well, before we do that, I want to look at the very important figure of the 50 million ounces. And this is a really important figure that I want to address because it's actually, it intersects with silver 3 times. So this is the Silver Eagle mintage, and you can see we have a dramatic increase since 2006 in the public's buying. We went from 12 and 10 million to 21 million to 30 million to 35 million, and we don't have 2011, but based on, I think there was an 11 million figure for the month of January turned in. Don't quote me on that, I may be wrong, but I believe we're on pace to do about 50 million this year. So that figure, 50 million, remember that number because it's going to come up 3 times. 1, it's going to be the number of Silver Eagles that are sold. 2, if you remember from if you remember from FOFOA's blog spot, that the 50 million is the amount of ounces that's delivered on the COMEX every year. Now you remember that 750 million to a billion roughly is the amount of silver that's mined and consumed every year, but of that, only a tiny percentage is actually delivered by the COMEX. That's roughly 50 million. And then the other 50 million ounce figure is the amount of silver that's mined within the continental United States every year. So you have this figure 3 times, 50 million. You have 50 million Silver Eagles that are sold every year in the U.S. You have 50 million ounces of silver that's delivered by the COMEX every year. And you have 50 million ounces that's mined inside the geographical United States. So that's a very strong figure. It's a very important number to keep in mind when we get back and start looking at these volumes that we're talking about. So let's go back to our volumes that we're talking about here. We're going to start with commoditycharts.com, and this is going to give us the daily. Now unfortunately I don't have a historical of the open interest. I'd love to have that, but I don't have that. If anyone has that, I'd really appreciate that information, but it's very hard to get. I'm not sure where Harvey Organ pulls his information from, but we'll look at Harvey Organ here in a second. But the first thing that jumps out at us here when we look at this open interest and volume, that this is today, this is August 5th, is that we traded 83,000, and we're just looking at the active month, the September month. We traded 83,000 contracts on an open interest of 59,000. So let's jump over to Harvey Organ and grab a couple of figures for the last couple days. And Harvey reported that the next big delivery month is September, and here the OI, open interest, rose from 58,000 to 59,000. So it's pretty much what we're seeing here. 59,490, same number. The estimated volume at the Silver COMEX was an extremely high 106. Confirmed volume yesterday was 85. So we've got 3 figures here. We've got 85,000, 106,000, and now we've got 83,000. So at least for these 3 days, and I don't know what it is in the past, but just looking at these 3 days, for one of those days, the volume on the COMEX was nearly twice the open interest. And for today, it was a significant percentage larger. So what does that tell you? What that tells you is that, quite to the contrary of what your normal guess would be, that in this type of a sell-off, you'd have a tremendous amount of open interest created to generate this type of crash and this type of volume. You would think that this is a lot of new silver shorts being initiated to pound this price down. Because to get this type of move, to trade this type of volume, 25,000 and 20,000 and all these numbers, to generate that type of volume, you would have to be creating all these new contracts, you would think, right? Or, on the contrary, if there was a tremendous amount of open interest out there and the price is just crashing because they're trying to generate liquidity because of a liquidity crisis due to the stock market collapse, and these people have to sell this asset to generate cash to cover their paper costs in the stock market, you would see open interest collapse. So what you would expect to see in either scenario with this move is open interest either collapsing or exploding. But that's exactly the opposite of what we see. We can see that open interest is hanging right around the 58 to 59,000 level every single day, even with volume of 106,000. Now, what does that tell you? Before I talk about that, I want to look at some of the other commodities so that you can get an idea. Let's go back and look at some of our other metals. So we've got gold, we've got copper, we've got platinum, we've got palladium. Let's take a look at gold in the active month. So that's going to be GC. Well, we'll look at Z. That's December. That may be too far out. So the December contract of gold is at 196,000. We go to the daily and we can see the open interest. So here you have, in the December contract of gold, you have an open interest of 383,000 contracts. And you have a volume of 196, so roughly half, a little bit more than half. So let's look at copper, which is September copper. With September copper, you've got an open interest of 80,000 and you've got a trading volume of 70,000. So roughly all the contracts that exist on copper turned over in that day. So that's the metals. We can look at palladium and platinum, but they're so tiny that it's not really informative. So let's look at something like, let's say, the grains, which is something that has a tremendous amount of consumption every day. So we've got September soybeans. Let's check those out. So you can see on September soybeans, the open interest on the main active contract, actually it's November soybeans, we have open interest of 298,000 contracts, and today we trade 107, so 1/3. So let's look at corn. In the ZCU is September, and we have 586,000 open interest in December, actually, and 183,000. So about a quarter to a third. So, and we can look at, and I encourage you to go and look at all these commodities. But the thing that really stands out when you look at these commodities is that silver is unique in that silver is actually doing a much larger amount of volume than its open interest. So what does that tell you? Well, it tells you, one, that in this sell-off, it wasn't a bunch of people creating new contracts to drive the price down. It also wasn't a bunch of people who had existing contracts who had to get out to raise cash. So what was it? From that move, we're going to have to conclude that this is actually the trading of algos. That, as Bixweir has said, that the price of silver is purely, let's go to a clean silver chart. We'll wipe out these. That this price move, I'll put the volume up. This price move right here, this is not a bunch of people with silver contracts trying to raise cash. This is not a bunch of people creating new contracts to sell it down. This is algos. This is buying, selling, buying, selling, buying, selling, buying, selling, buying, selling, buying, selling, all the way down. This is false volume generated by computers to control the price of this commodity. That's the only conclusion you can come to when you look at the fact that the open interest is essentially unchanged for the last 3 or 4 days, but the volume is actually larger than the open interest. So we're talking about a bunch of computers or a bunch of traders who are buying and selling, just like the May flash crash in the stock market. You're talking about a market that is fake, a completely fake market. And if you want to see a fake market, all you have to do is look at the Fed funds rate. It's at 0%. That's not a market. That's government manipulation of interest rates. That's government manipulation of the price of silver. And with the headline you have today, that is a rating agency saying that the government manipulation of these things is soon coming to an end, and it may come to an end on Black Monday, but we'll have to wait and see. And we'll talk to you next time.